Did you know that the stock market has produced an average annual return of about 10% over the last 90 years? But here's the shocking part. Most people aren't even close to hitting that number. In fact, studies show that individual investors typically earn only about half of the market's return because they buy and sell at the wrong times. But what if you could change that? What if you could beat the market by simply adopting one proven strategy: value investing? This isn't about jumping on the latest trend or hoping to get lucky. It's about buying stocks that are undervalued, holding them for the long term, and letting their true value shine through. This approach has made billionaires out of everyday investors like Warren Buffett, who built his wealth by following simple, effective strategies. In this video, you'll learn exactly how I started my journey into value investing from scratch. We'll go over key strategies that can help you find undervalued stocks, manage risk, and build a portfolio that creates passive income over time. No gimmicks, no hype, just proven methods that have stood the test of time. Stick around, and by the end of this video, you'll have a roadmap to start investing like a pro. Let's dive in. Chapter 1. The Value Investing Mindset. Think like a billionaire. Value investing isn't just about buying stocks, it's a mindset. The goal isn't to chase quick wins, but to find undervalued companies that will grow steadily over time. Legendary investor Warren Buffett once said, "Price is what you pay, value is what you get." It's all about finding stocks that are priced lower than their true worth and holding onto them until their value is recognized by the market. For a lot of new investors, the idea of value investing can seem slow. However, patience is key. Buffett's success didn't come from rapid trading. It came from buying quality companies at great prices and holding them for the long haul. Think of it this way: value investing is like planting a tree. You invest today, and with time, it will grow and give you returns. The first step in adopting this mindset is to stop looking for instant gratification. When you think like a value investor, you're looking for companies with strong fundamentals that are trading for less than their intrinsic value. A good rule of thumb is to focus on companies with a consistent record of profits, a solid competitive edge, and a management team that knows how to create value over the long term. You might ask, how do I identify these companies? It starts with understanding financial statements, specifically, the balance sheet and income statement. But here's the kicker: value investors don't just look at numbers. They look at the story behind the numbers. Is the company growing its market share? Is it positioned well in its industry? Take the case of Amazon. In the early 2000s, it was barely profitable, but Warren Buffett avoided it because its stock price was high, and its future was uncertain. But Amazon was investing heavily in growth, and that strategy paid off. Sometimes, it's not about what a company is doing today but what it could do tomorrow. Chapter 2. Unlocking Hidden Gems. Where to find undervalued stocks. If you want to succeed as a value investor, finding those hidden gems is essential. Many value investors believe you can't find opportunities in well-known, high-profile companies. Instead, you need to dig deeper. As Peter Lynch, a famous investor, once said, "Invest in what you know." But it's more than just knowing a brand, it's about understanding the market dynamics and financial health. Start by looking at small-cap stocks or industries that are out of the spotlight. While blue-chip companies are reliable, they often come with a higher price tag. Small-cap stocks, on the other hand, tend to fly under the radar. These companies are often misjudged by the market, presenting opportunities for value investors. One unique place to look for undervalued stocks is in fallen angels. These are stocks of companies that once were market darlings but are now struggling, often due to temporary issues. If you can identify the reasons behind the struggles and believe the company has a turnaround plan, these companies can be a goldmine. However, it's important to avoid value traps, which are companies that appear undervalued but are actually declining for structural reasons. To spot a true gem, look for strong fundamentals, consistent earnings, and management's ability to adapt to market changes. Technology can also play a role in identifying undervalued stocks. Tools like stock screeners can help you filter out companies that meet certain financial criteria, such as a low price-to-earnings (P/E) ratio, low debt, or a solid track record of profits. But don't rely solely on the numbers, do the research and look for the underlying story. Another valuable source is niche industry reports. These reports often highlight smaller companies in growing sectors that have the potential to outperform the market in the future. Think of industries like renewable energy, electric vehicles, or cybersecurity. These sectors may hold future winners that are not yet on the radar of mainstream investors. Chapter 3. The Power of Patience. Why time is your best friend. Patience is more than a virtue in value investing, it's a necessity. One of the most powerful things about value investing is that you're in it for the long haul. In the short term, stock prices can be volatile, but over time, quality stocks will often rise to reflect their true value. Buffett's strategy is a great example of this. He doesn't invest in companies because they're cheap today, he invests because he believes they will grow over time. In fact, Buffett famously said, "Our favorite holding period is forever." When you invest in high-quality companies at fair prices, the power of compounding works in your favor. Let's put this into perspective with some numbers. A $1,000 investment in Coca-Cola in 1988, when it was priced around $2.50 per share, would have turned into over $100,000 by 2020, including dividends. That's the magic of long-term investing. It allows the power of compound interest to transform your initial investment into a growing asset. Another reason patience is so crucial is that it allows you to ride out market downturns. The stock market goes through cycles, with periods of boom and bust. But if you panic and sell during downturns, you might miss out on the eventual rebound. In 2008, when the market crashed, many value investors scooped up discounted stocks, and those who held on have seen significant returns. A key piece of advice is to focus on the company's fundamentals, not the daily price swings. If you invest in quality, undervalued companies, you don't need to worry about short-term price drops. Instead, ask yourself, does this company still have the same potential for growth? If the answer is yes, patience will pay off. Most importantly, value investing requires a long-term vision. It's about building a portfolio of quality companies that will grow steadily, not trying to time the market. The patience to wait for these companies to rise to their true value can be one of the most rewarding strategies in investing. Don't forget to subscribe for more expert strategies on value investing, building passive income, and managing your portfolio the smart way. Chapter 4. The Art of the Deep Dive. How to analyze a company like a pro. When it comes to value investing, deep research is non-negotiable. The more you understand a company, the better your investment decisions will be. You can't rely on stock tickers or headlines alone. You need to dive into financial statements, industry trends, and the company's future potential. Legendary investor Benjamin Graham, who is often called the father of value investing, said, "The investor's chief problem, and even his worst enemy, is likely to be himself." In other words, don't let emotions or market hype drive your decisions. Start by looking at a company's balance sheet. This provides a snapshot of its financial health, showing its assets, liabilities, and shareholder equity. The goal is to find companies that have strong assets, manageable debt, and a solid cash flow. A company with more assets than liabilities is often in a better position to weather downturns. Next, look at the income statement, which shows the company's profitability over time. Pay attention to revenue growth, operating margins, and net income. Healthy revenue growth coupled with improving margins is often a sign of a strong business model. Don't forget about the company's cash flow statement. A business can look profitable on paper but still struggle if it doesn't generate enough cash to support operations. Cash flow is king, and a company that consistently produces positive cash flow is often a solid investment. In addition to the financials, understanding the company's competitive position in its industry is crucial. How does it compare to competitors? Is it a market leader or a struggling player? For example, during the rise of online shopping, companies like Amazon were able to capitalize on the e-commerce boom while traditional retailers were slower to adapt. Look for moats around a company. A moat is the competitive advantage that keeps other companies from taking its market share. This could be a strong brand, intellectual property, or a cost advantage. For example, Coca-Cola's brand and distribution network are so powerful that it's difficult for competitors to challenge them. Finally, pay attention to management. A company's leadership is often the difference between success and failure. As Warren Buffett says, you look for three things in a person: intelligence, energy, and integrity. If they don't have the last one, don't even bother with the first two. A strong, honest management team can navigate challenges and maximize shareholder value. Chapter 5. Risk or Opportunity. How to manage risk without sacrificing growth. In the world of investing, risk is inevitable, but it's also manageable. The goal of a value investor is not to avoid risk entirely but to understand and control it. One way to do this is by diversifying your investments. If one company underperforms, others in your portfolio might pick up the slack. But diversification is not just about owning as many stocks as possible. It's about owning stocks that don't all move in the same direction. One popular way to manage risk is by focusing on industries with different market cycles. For example, during a recession, consumer staples like food and healthcare tend to perform better than luxury goods or technology. By spreading investments across sectors, you can reduce the overall risk to your portfolio. Another strategy is to focus on companies with a strong margin of safety. This is the difference between the price you pay for a stock and its intrinsic value. The greater the margin, the lower the risk. Benjamin Graham, in his book The Intelligent Investor, explains that buying a stock with a margin of safety allows you to avoid losing money, even if the market doesn't recognize the stock's value right away. It's also important to understand the difference between volatility and risk. Volatility refers to the short-term fluctuations in a stock's price, while risk refers to the long-term possibility of losing money. A volatile stock can be a great opportunity if it's undervalued, but you need to have the stomach for the ups and downs. One way to deal with risk is to avoid speculative investments. Speculation is based on predictions of future prices, often without regard for the company's actual fundamentals. This kind of investing is risky because it's hard to predict short-term movements. Value investing, on the other hand, focuses on intrinsic value, which is grounded in the company's real worth. A good example of this strategy is investing in established companies with stable earnings. These companies may not have explosive growth potential, but they provide consistent returns and lower risk. Coca-Cola, for example, is not a fast-growing stock, but its reliability makes it a favorite for value investors who want steady, low-risk returns. Another risk management tactic is to avoid chasing the market. When you buy a stock simply because it's trending upward, you're exposing yourself to greater risk. Stocks can become overvalued in a hot market, and when the bubble bursts, you might be left with losses. Chapter 6. Passive income through value investing. Building your portfolio to last. Value investing isn't just about buying and holding. It's about building a portfolio that can generate passive income over time. Once you've chosen your stocks, the goal is to hold them long enough to collect dividends and see them appreciate in value. Dividends can be a powerful tool in building passive income. A consistent dividend-paying stock not only provides regular cash flow but also signals financial health. Companies with a strong dividend history, like Johnson & Johnson or Procter & Gamble, often make excellent additions to a value investor's portfolio. These companies have a track record of generating steady income, which can be reinvested or used as passive income. In fact, reinvesting dividends can lead to exponential growth over time, especially when you take advantage of compound interest. To maximize passive income, consider a strategy of dividend reinvestment plans, DRIPs. These plans automatically reinvest your dividends back into the stock, purchasing more shares and increasing your investment without you having to lift a finger. Over time, this can significantly increase your holdings and your returns. A well-balanced value investing portfolio should include a mix of high-quality stocks that offer dividends and the potential for price appreciation. While the stock market will fluctuate, these companies tend to recover over time and reward long-term investors. The goal is to create a self-sustaining portfolio where the returns from dividends and capital appreciation will fund your lifestyle. But remember, building wealth through value investing takes time. This isn't a get-rich-quick strategy, but rather a slow and steady one. However, if you follow these strategies, you'll eventually reap the rewards of compound growth and passive income. Keep an eye on your portfolio, reassess every few years, and add to it when opportunities arise. One key to success is avoiding the temptation to sell too early. Often, the best passive income comes from holding onto your stocks for years, even decades. This approach requires discipline, but if you stick with it, you'll build a portfolio that generates income for years to come. Don't forget to subscribe to get more expert insights on investing, passive income, and growing your wealth over time.